does take us to our talk of the tape. How best to play the markets right now as the tape tries to broaden once again. Let's welcome in Dan Greenhaus. He's the chief strategist for Solus Alternative Asset Management. It's good to see you again.
Thank you, sir.
It's been really a fantastic 3 days here. What do you make of this rebound?
Listen, we've talked about this, and all of us on the show have talked about this for some time. Recession worries are lingering in the air. The latest thing, obviously, are the comments coming out of some conferences. You were at one, the real estate conference, where some financials made some negative comments, gained some play. But listen, I think at the end of the day, my favorite saying, the U.S. consumer continues to do well, the economy continues to do well, profits continue to print above expectations. And so while we had a meaningful sell-off driven by some of those AI names for sure, the rebound seems entirely justified to me because it doesn't seem like these issues are broadening out beyond what we've seen for the last few quarters.
What about the reversal yesterday? I mean, the price action in the market was so interesting to follow. If you had only tuned in at the end of the day, obviously, you would have missed a pretty good story. Here we are week to date. NASDAQ's up better than 5%. S&P's up almost 3.5%. What do you make of that?
Yeah, I mean, I took a look earlier today. It's not unusual to see a market at one point, see the equity market at one point down a full percentage point and then close up a full percentage point. That's not completely unusual, but it is also the type of thing that you sometimes see at market bottoms. You saw it in October of 22 when the market bottomed. You saw it around the time of the COVID low in 2020. You saw it back in 2011. There's a few more instances where it occurred and it was not necessarily a bottom, but that type of reversal, those of us that have been in markets for a while, you look at that action and you say, okay, it doesn't necessarily mean automatically capitulation, whatever your definition needs to be, but there are instances in which that signifies capitulation, and it's of course possible that yesterday was one of them.
It's that 5,600 level that here we are again on the S&P. You know, that's sort of been the main line in the sand that we've had a reasonably tough time getting over.
Yeah, listen, I mean, the latest thing, of course, is the yield curve uninverting. And as a longstanding card-carrying member of the Yield Curve Inversion Matters team on the show, it's obviously something to pay attention to, that the 2-10s curve in particular is now in positive territory, although not firmly in positive territory. Call it a couple of basis points, 3, 4, 5 basis points. But the curve inversion is the latest thing that's giving people some worry, and obviously that filters through to markets. But listen, whatever the inversion may or may not be saying, you could counter that by simply looking at something like credit spreads, which remain for IG and high yield both well contained. And so I think you look at cross assets and you continue to get the same message, which is that for now, everything looks A-OK and likely to continue along that path.
Does 50 or 25 or 50 basis points matter at this point? I mean, I ask you, I know obviously where expectations are, not just from most of the market participants that we speak to, but even CEOs. You mentioned the conference that I was at yesterday, spoke to David Solomon, chairman, CEO of Goldman Sachs. It was their conference, of course. And I want you to listen to what he told me about what he thinks is going to happen.
Our best guess is 25, but, you know, I think there's a case to be made for 50 based on a little bit more softening of the labor market. I think we'll see. I think the percentage chance was in the low 30s.
So how, Dan, do I handle that? So 25, obviously likely, but the case for 50 implies that 50 might be needed. How do you see it?
Well, listen, I know plenty of people in markets, informed, educated, astute followers of markets and economics that think there's no case for a rate cut at all and think the Fed should stay pat. So I think this is one of the more confusing moments in time from a predictive standpoint. My own, as I've said repeatedly on the show, my own view is that I think they're probably going to cut by 25 basis points, and it will be the first of several cuts. The case for 50 is just, and being made by several people, is that the Fed is just too far behind the curve, that inflation has now normalized. Depending on your measure, you're somewhere in the mid-2s. And with the economy slowing down, although, again, from an exceedingly high pace in the end of last year, and the labor market weakening, the Fed is increasingly looking like they're offsides. This is the 50 basis point argument. And so what is the reason to go slow to getting back on sides? You're going to have to cut by 100 basis points. You might as well get there more quickly than not to take out insurance. there's validity to that argument, as I find validity in my own argument, which is that they should reduce by 25 basis points, as I find in the argument that they would be justified for standing pat. Again, I don't think there's a concrete case. There often is, but I don't think there's a concrete case this time around that they should cut by any one of those three scenarios. And I would mind you, when you look at markets, when you look at the home builders, when you look at some of the retail names, a lot of these cyclical parts of the stock market are at or near highs. And I don't think that I see in assets I mentioned earlier any sort of broad economic worries, the likes of which would justify a more rapid case of rate reduction. I can point to any number of sectors of the stock market that are doing just well with rates at, call it 530 or whatever.